Welcome to the first video on the weighted average cost of capital. We're going to have two presentations of the weighted average cost of capital. One presentation is going to take you through estimation of project discount rates. The next presentation is going to take you through the relationship between financial leverage and the weighted average cost of capital. That is a lead up to subsequent discussions we're going to have about what we call capital structure. Capital structure in corporate finance is some analysis of whether we think it's optimal to finance our business with high amounts of debt or high amounts of equity, and there are trade-offs between those two alternatives. So again, we're going to skip back between Excel and the PowerPoint presentation because this is going to be a very practical discussion, but I'm going to start off with some discussion in PowerPoint. So let's talk about project discount rates. One of the first principles that we have in finance is that the discount rate for any individual project depends upon the risk of the project. It doesn't depend on who owns the project. So for example, Disney owns media companies, ESPN and ABC. It owns resorts such as Disneyland, and it owns the studio entertainment businesses, Pixel and Marvel. Those particular investments should have discount rates that reflect the risk of those investments. So it might be, for example, riskier to have a studio entertainment business versus a resort or a media company. Now, I don't know, I haven't actually measured the risk of those investments, but they could have different risks and therefore discount rates. So those three projects should be valued using a media discount rate, a resort discount rate, and a studio entertainment discount rate, respectively. GE owns power businesses, gas and steam turbines and power generators. It owns renewable energy businesses like hydro and wind equipment and service, and transport business, namely locomotives and other segments. Those projects should be valued using a power discount rate, a renewable energy discount rate, and a transport discount rate. Now you'll see companies in practice use the same discount rate for all their projects, and that's fine. Because those companies might have concluded that even though we have these different projects in different industries, and in theory they should have different discount rates, we've concluded that discount rates have such high estimation error that coming up with a separate discount rate for media, resorts and studio entertainment is a pointless exercise. So Disney might say, okay, I know you said in theory that they're in different industries, they should have different discount rates, but given all the estimation error, which we've talked about in previous presentations for discount rates, I don't really know whether the media business or the resorts discount business or the studio entertainment business actually has the highest or the lowest discount rate. Measuring this variation in risks across industries is really hard. And so Disney might say, that's a pointless exercise, it's a distraction from our executives. We could be shifting our project valuations and therefore our capital allocation around because of just estimation error and deciding on discount rates. Let's not do that. So we'll have the same discount rate for all our businesses, and it might be an estimate that we say is the Disney discount rate. But the key thing you have to understand is that it's not based upon Disney being the owner of the business. If I was another business that owned a theme park or another business that owned a studio, right, the discount rate for a studio business, what someone thinks is a fair return for investing in a studio, shouldn't change because Disney owns it or I own the business. It's a studio discount rate, but Disney, or in the alternative case GE, might decide I can't accurately measure the differences in risks across my projects, so I'll just use the same risk, and therefore any allocation of capital across those different investments is going to be determined by their prospective cash flows. This is a crucial point for your understanding about the way we allocate capital amongst government-owned businesses and across private-owned businesses. Who's got the lowest cost of capital? The government. Why does the government have the lowest cost of capital? Because it can use taxation power to repay its debt. Now, sometimes that fails. There are occasions where governments default. For example, Detroit, as a government, defaulted on its debt some time ago, and that occurred because Detroit became financially distressed. Detroit made promises to employees like teachers and firefighters and police and other public service relating to pension entitlements that ultimately couldn't be funded because the tax base in Detroit couldn't support those payments. There wasn't enough money, and Detroit went into bankruptcy. At the sovereign level, countries have gone into financial distress. We've had defaults in some South American countries, we've had some defaults in some European countries, but the US government and the Australian government and the UK government have not defaulted on their debt. And that's because the debt obligations of those countries have been sufficiently low relative to the size of the economy that even if there's an economic downturn, there is confidence the government will be able to make the repayments. So the government can use this taxation power, increasing or decreasing taxation, to make good on its promises. So the government has the lowest cost of funds. But if you were to analyse projects on the basis of who has the lowest discount rate, who do you think should end up owning all the projects? By extension, it would be the government owning all the projects because the government has the lowest cost of funds. You could say, well, airlines have a 10% discount rate, they're pretty risky bets. Wouldn't the value of the airline go up if the government bought all the airlines? Instead of having a 10% discount rate, we've got a 2% discount rate, and the value of the airline would increase. But that's not true. That's because the risk of the airline is associated with the risk of the assets. All that would happen is that if you applied a discount rate of 2%, say a government bond yield of 2%, to value the airline, what you just mean is that the government is subsidising the return to shareholders to the return of 8% by taking on the risk of default of the airline. So the airline might default, or the airline might get into some other risk, or the airline might be exposed to systematic risk. Whatever risk is factored into that 10% discount rate, the government would be taking that on and insuring investors, if you thought the discount rate was 2%, against those uncertain outcomes. So all you're doing is increasing the value of the airline, but decreasing the prospective cash flows that taxpayers would be entitled to. Or in other words, there's just a wealth transfer from government to the owners of the airline, the previous owners of the airline, if the government bought those airlines. So in short, we don't have different discount rates based upon who owns the project. We don't have a different discount rate depending upon whether Warren Buffett or the government or some other high wealth individual owns a project. We don't have different discount rates because GE owns resorts, or Disney owns resorts, or GE owns power. We have discount rates based upon project risks, but sometimes we use a company-wide proxy because measurement error is large and it makes no benefit to our decision making if we have different discount rates across different divisions of a business. Let's define what a project is. A project, in quotation marks, can be investment in a whole business or an individual asset. So for example, if you're considering an investment in BHP, which is a large iron ore mining company, or an investment in an iron ore mine, both of those investments could be considered projects in our terminology. And you can use the same estimation approaches described in this presentation to come up with your valuation of BHP or a valuation of an iron ore mining project, an individual mine. The term weighted average cost of capital is the discount rate we're going to use for determining the enterprise value of a firm, that is the value of debt and equity combined, using our free cash flow approach, which we've covered in a few different modules. The term we're going to use, the cost of equity capital, is a discount rate that we're going to use for determining the value of equity within that enterprise or the firm using the dividend discount model. On the slide you can see a definition of the weighted average cost of capital, and this definition applies in a market in which you can deduct interest expense from tax payments, and that's why we've got cost of debt times 1 minus the corporate tax rate in the equation. So here's what the equation says. The weighted average cost of capital is going to be a weighted average of the discount rate applicable to equity holders times the proportion of equity used to fund the business as a ratio of debt and equity. We're going to add in the cost of debt times 1 minus the corporate tax rate multiplied by the proportion of debt used to fund the business. That is debt divided by debt plus equity. Recall when we applied our free cash flow model several different times to value projects or value an entire firm, we had an equation that started off with free cash flow equals after-tax operational profit. We then added in any income statement items that were non-cash, so we reversed accounting statement items that weren't cash flows like depreciation. And then we incorporated any cash flow items which had not yet flown through the income statement. That definition of cash flows is what we often call ungeared or unlevered cash flows. And what that means is that we've got the same definition of cash flows irrespective of whether the company has taken on debt or no debt. Interest payments and the tax deduction of interest payments didn't factor into that cash flow definition anywhere. But they do factor into a discount rate. What the discount rate accounts for is the fact that your effective cost of debt is going to be reduced by the fact that you can use as a tax deduction your interest expense. And that's where cost of debt times 1 minus the corporate tax rate comes in. We are factoring in the present value of all of those tax breaks for interest expense into our discount rate instead of our cash flows in valuation. What are these weights, the weights of debt versus equity that you can see in these two boxes? If we know that a project is going to be financed with X% debt and 1 minus X% equity, for example, you know a project is going to be financed with 30% debt and 70% equity, you use those weights. So you might say, debt holders are putting in $30, equity holders are putting in $70. That's a 30%, 70% debt to equity ratio. But if we don't know the percentage debt, or we don't know the dollars of debt, we're going to come up with an estimate of the proportion of debt versus equity funding based upon the market value weights of comparable firms within that industry to value a project. There is one additional piece of information that I want you to pay close attention to. We're not going to cover it in this particular course. We're going to cover it in my later course, FAN 415, Corporate Investment Decisions. There are some circumstances, I should correct that, there are most circumstances in which as soon as you make the assumption that a project is going to maintain a constant percentage of debt, but you know how over time, but you know how much debt it's going to take on at the start, for example, $100 million of debt, you don't need to look at comparable firm analysis at all. There is a unique solution to the leverage ratio which goes into this equation, and which is going to come up with the correct discount rate and therefore the correct valuation. So in most circumstances, if you make the assumption that a project is going to have X% of debt every year, like we have in this weighted average cost of capital, the percentage of debt is constant, but then you say, but at the start we're going to take on so many dollars of debt, then there is a unique solution for what that percentage should be. And I don't need to get that number from comparable firms, and I don't need to have it imposed on the analysis like the first bullet point here. Be very careful about your assumption about the proportion of debt versus equity that goes into a discount rate, because it can materially impact your valuation and create estimation error. And that is something I expand upon in my later course, but it's not part of what we're doing here. Okay, so let's look at book value weights first. Some analysts ask themselves the following question. If we are going to apply equity and debt weights to come up with a weighted average cost of capital, and I'm doing this analysis for a company in which I can't observe its market value, it's not a traded company, how am I going to come up with those weights? maybe I could start with the book value of debt and the book value of equity. But we have said repeatedly that we are not going to use the book value of equity in valuation under any circumstances. And the reason for that is that the book values in most situations are a completely unreliable proxy for market values. Look at the book values on the screen for Amazon, Disney, GE and Lyft. They tell you nothing about the market value of equity. The book values are a result of years of cumulative accounting choices, dividends and share repurchase policies and asset write-downs. Now it's tempting to look at the balance sheet and say, well, there's the book value of equity, that's a number I can use. Let's use that for my weighted average cost of capital. But the impact of this error in your discount rate computation is so large that all of your good analysis in which you forecast cash flows by looking at a very high, very detailed granular level and thinking about the long-term growth rate, coming up with your business model, all this great analysis is unravelled by having some unreasonable estimate of the discount rate. So you can't use book values as a proxy for market values. If you have to use some proxy, you have to go to comparable firm analysis as a starting point to come up with market value weights. Now you did that for a beta estimation, presumably. You probably did that for some multiples analysis. Why can't you use those same comparable firms to come up with market value weights for debt and equity? When it comes to debt though, you can use the book value of debt as a proxy for the market value of debt in most circumstances. But what you can't use is the book value of equity as a proxy for the market value of equity in almost every circumstance. Banks is an exception. For many banks, the book value of equity can be a proxy for market value of equity, still with like a 30% plus or minus margin of error, because the majority of assets and the majority of liabilities on a bank's balance sheet are financial assets and financial obligations. And those are going to be recorded on the balance sheet at some reasonable approximation of market values. What cash what loans we have, that's our assets, our accounts receivable, and our liabilities, what money we borrowed from depositors and in the wholesale markets. In terms of project discount rates, we have to think about the cash flows. The cash flows for valuing a project are exactly what we've covered earlier in the course. After-tax operational profit plus a reverse of non-cash items that were incorporated into the income statement, like depreciation, and then a reversal of any, or incorporating any cash flows that didn't flow through the income statement, like capital expenditure and changes in working capital. As I mentioned earlier, those are ungeared cash flows, also called unlevered cash flows. They don't change depending upon how much financing the business, how much debt finance the business has taken on. In estimating discount rates for a project, we can use our capital asset pricing model, even though it's biased, imprecise and incomplete, and we can estimate beta using a 10-year government bond yield, so the risk-free rate estimate using a 10-year government bond yield, beta by regressing stock returns and market returns for a large sample of comparable firms using all available returns, and repeated 5 times for different definitions of a WACC. And we can estimate the market risk premium in a couple of ways with reference to historical data: average market returns less the risk-free rate, an average real market return converted to nominal market returns using today's inflation, and then subtracting the risk-free rate. Can we do better? Yes, we can, but those other models are beyond the scope of our course, so this is what we're going to use here. For the cost of debt, we need a yield on the debt that's consistent with the assumed debt versus equity mix. More debt relative to equity means more risk to the lenders, and therefore should be associated with a higher cost of debt. As a practical matter, to estimate the cost of debt, you want to look at the yield to maturity on bonds that have a similar credit rating to the project that you're analysing. Now, your project, or you might not have a credit rating, so you can come up with a proxy credit rating. You could say, well, this project has some financial ratios that would imply a credit rating of AA or single A or triple B and so on. And then based upon that proxy credit rating or the pseudo credit rating, you could look at the yield to maturity on bonds that have that similar credit rating and that would be your estimate of the cost of debt. Finally, we need a corporate tax rate, and typically we just use a statutory tax rate of 21%, and that's what I'm going to use here. That can be adjusted based upon a particular firm's characteristics, like tax losses carried forward or unusual write-offs, but we're not going to do that here. We're just going to have one tax rate because there's only so much we can cover in one introductory course. Now that makes not much sense unless we actually do some computation, some analysis. So I'm going to take you through the discount rate estimation for a mining project, and you can replicate all of these computations in the accompanying spreadsheet. So if you said to me, estimate a discount rate for a mining project, this is exactly what I would do. Probably with a larger sample of comparable firms, but this would be my approach. First of all, I would say I need a model for coming up with the cost of equity. Now, I would use something in addition to the capital asset pricing model, but assume I say I'm going to use the capital asset pricing model. What would I do as a first step? I'd estimate the risk-free rate as the yield to maturity on 10-year government bonds, just like we did in a prior presentation. To get that yield to maturity, I would go to the Federal Reserve website and convert that annual percentage rate yield to maturity to an effective annual rate. Done. Secondly, I need an estimate of the market risk premium, and I would do the following. I would come up with a baseline estimate for the market risk premium using historical returns information. I would use two definitions of the historical returns. I would say one data set I could look at is historical excess returns. Nominal market returns minus the government bond yield at the start of the year, and I would take an average of that figure. Secondly, I would take real returns in any given year in my historical data, take an average, convert those to nominal returns using a current estimate of inflation, and then subtract the current estimate of the risk-free rate. And that would give me a second estimate of the baseline market risk premium, and I would average those two estimates. Thirdly, I would incorporate contemporaneous information about the market. Earnings yield minus the risk-free rate, the corporate bond spread, the term spread, and implied volatility to shift my market risk premium estimate upwards or downwards from that baseline. Now in our class we haven't done a computation of that. I'm just making you aware that the computation can be done and you might want to consider it in some future analysis. And suppose I had actually done all that analysis and I'd come up with a market risk premium of 7%. Third, I need an estimate of beta. What would I do? Suppose I took these 5 mining companies, BHP, Rio Tinto, Anglo American, Glencore and Vale. In reality I would use a much larger data set, but this is to keep the presentation manageable. I would estimate beta for each of those companies using weekly returns. I would use all available returns information, and I would do that beta estimate 5 times using different definitions of a week, Monday to Monday, Tuesday to Tuesday, and so on, to come up with an equity beta for each company. And then I would take an average of those equity beta estimates. And in the actual data that I used in these computations of the presentation, the equity beta was 1.5. Now I used a median there. I could have taken an average, that would have been no problem. There's no problem with taking an average of those beta estimates. But I happened to take a median for this presentation. I would combine those numbers together and say my estimate of the cost of equity using the capital asset pricing model for those comparable firms is 13%. Risk-free rate of 2.5% plus a premium for bearing systematic risk of 10.5% gives me 13%. Thirdly, I need an estimate of the cost of debt. These firms have credit ratings. Those ratings are issued by agencies like Standard & Poor's, Fitch and Moody's, although there are other ratings agencies. The credit rating is a proxy for the probability of default and what lenders will recover if default occurs. Lower credit ratings like the BB rating for Vale are associated with higher yields. Higher credit ratings like the A+ rating for BHP are associated with lower yields on debt. I would then look at the yield to maturity on bonds that have the same median credit rating. Now I've taken a median here because these credit ratings are categorical variables. You can't average the credit ratings in a meaningful way, but the A- rating lands in the middle of these 5. And data providers like Bloomberg or Thomson Reuters, they produce what's called yield curves. And that yield curve might say 10-year bonds with an A- credit rating are typically trading at a yield maturity of X%. So I would say, well, a typical mining project based upon these proxy firms is going to have debt at a rate of 3.63% in my example. So I would use that as the cost of debt. I would use a corporate tax rate of 21%, and then I would have to say, I need an estimate of leverage here. I need an estimate of the debt to debt plus equity ratio. I would look at the book value of debt on the balance sheet for each firm. I would look at the market value of equity, that is the market capitalization, a share price times the number of shares in issue, and I would add those two together to give me an estimate of debt plus equity. And the ratio of debt to debt plus equity as a median across those firms is 18%, and the equity proportion is 82%. Now again, there would actually be no particular problem with taking an average from these firms, but I happen to have taken a median. If I take an 18% weight applied to the cost of debt and incorporate the 1 minus tax rate factor, because I did not incorporate the tax deduction for interest payments in my cash flows, and an 82% weight on the cost of equity, that gives me a weighted average cost of capital for those comparable firms of 11.2%. And I would say, well, that seems like a reasonable estimate of the discount rate that I would use in a mining project. Now, it's not necessarily the best discount rate. The mining project might have particular features, but that would be a useful starting point based upon these mining companies. Note, however, that if you tell me the dollars of debt is going to be a particular number, like you see on this slide here, $100 million of debt, and you tell me that in addition to that dollars amount of debt, that the mining project is going to have a particular percentage debt, which is maintained every single year going forward, there is a unique solution to the leverage which is going to come out of the analysis without doing any of this comparable firm stuff at all. But if you just tell me that you don't know what the percentage of debt is going to be and you don't know what the dollars of debt is going to be, then this is the approach that we're going to take. I would say we're going to use an 11.2% discount rate. That concludes our first presentation on the weighted average cost of capital. The next presentation is going to provide an outline of the relationship between financial leverage and the cost of equity, and that's going to be a precursor to a broader discussion on capital structure, which will be coming up.